Hey everyone, and welcome back to the Eco Investment Update for January 17th, 2016. And it's another, ugly day outside, but a great day to be in front of the fireplace doing our weekly Eco Investment Update. There's no getting around. You can put lipstick on a pig, but you'll still call it a pig. You look at the stock market last week, you look at the stock market since the last week of December, and it's been nothing except a pile and a pit of misery for most investors out there. And consequently, I've gotten a lot of inquiries over the last, 3 or 4 days in particular. Will you please go to, I used to do every other week, and then I started doing a weekly format, and people started asking me now to do a daily format on the channel, and I really want to resist that because things don't change. Although you may be led to believe that things change rapidly in the markets, the reality is when we're on a boat that's being piloted and we understand the waters ahead and we understand the river and we know where the rocks are and we got our warning signs in midsummer that there's trouble ahead. When we had that terrific smash down to the 1500 something level, and then we had the recovery. Well, the big issue was we never really made new higher ground, and consequently, for quite a while, I guess since summer, we've been on a red light here on the market. So what is there really to update on a weekly basis? We had our thesis, my particular thesis, that the only thing that will kill a bull market is rising interest rates. And then we had to throw out that working thesis and replace it with a thesis that said, at no time in history has government intervention been heavier than it is today. In point of fact, the Federal Reserve has swelled up their reserves to an incredible $4 or $5 trillion of assets, all in the hope of stimulating, driving down long-term interest rates. And in fact, all it does is gave a short period of reprieve where a lot of people that were used to the usual flow of recoveries and ebb and flow of the business cycles naturally were led to believe that things would be improving. In point of fact, it was putting a lipstick on a pig, and underneath the surface there were dynamic forces taking place everywhere from energy to retailing to employment that in total and in aggregate have equal problems. You throw China on top of that, you throw terrorism on top, and the continuing battle with placing refugees, and the tension in the world is really palpable, and you can definitely feel it and sense it. And in that type of environment, it's like, why should we be bullish on that? When I look ahead and I see things, and I've been negative since the summertime, and that's been over 6 months, going into the 7th month. When I look out and look ahead, I only see problems ahead here. I see oil prices below $30 a barrel. If you had told somebody a year and a half ago that in January of 2016, oil prices for West Texas Intermediate crude will be below $30 a barrel, they would have told you you have rocks in your head. 2 years ago at Christmas time, I told Bobby probably by Christmas of 2015 or 2014, we'll see oil below $50 a barrel. This was when it was about $80, $90 a barrel. Well, guess what? I was about a year off. And now we've reached a point, December of 2015, January 16, where we're seeing that oil price, because so much supply came on, because the price was artificially held up for so long by the quote cartel unquote. Well, you put all those things in the pot and it makes for a really bad brew. People have asked me, if I haven't liquidated yet, should I get out of the market? And You know, it's really a difficult question. I don't know your financial situation, so therefore I'm no longer a registered investment advisor or a commodity trading advisor like I used to be. But all I can tell you is this, that I don't see any indication of strength here. And I know a lot of people, as we've gone down, we've lurched down this initial 10% in the market, and it's been real painful for people. But the problem is, the market has seemed to lack the ability to really sustain a meaningful rally. Now, last Sunday's update, the Eco Investment Update, I specifically mentioned that I was looking for a rebound coming into the week. And Tuesday we had that 300-point update, but by the end of the day we had already started whittling down to 110, 190 points, 200 points or so. In other words, there was people that were eager to sell into that strength, and then we just took that vicious tumble again, and we're right back in the sauce here. So I don't do short-term sort of work. I just know I'm on a negative sort of red light until such time as I see factors that indicate that there's positive action ahead. We've got a lot of stuff to go through here. We have a lot to work through. We have a lot of we have a United States Federal Reserve that's totally out of step. They're just in some alternative universe where they were sensing some kind of strong recovery because people are picking up part-time jobs here and there, ignoring the fact that wages are low, ignoring the fact that in history we've never had such a low labor participation rate, ignoring the fact that wages are falling behind and people are being gutted by things like rising health insurance costs and grocery store things and utilities. They're being gutted for that kind of stuff, and they don't have that cash to move forward. So then we have the additional aspect of a student population that's carrying $1 trillion of student loans. I mean, this effectively takes the younger people that would be on the first step of apartment ownership or home ownership and puts them in, still with mom and dad and struggling underneath the loans. It's a complication that's caused log jams in our economy. All this stuff has to be worked through, and it's going to take a long, long time. If you give you a little homework assignment, if you look at a chart of the Dow Jones Industrial Average going back from, say, 1982 to the current time, you have to put what's happened in the context of where we are right now. We started at the 777 level in August of 1982, and I remember that like it was yesterday because I was riding down the road in my car and caught the market report, and it was like at that time, like a 35-point rally, which was unheard of. It was a smashing day, and it went from 777 to like 8 something in a day, and it was like incredible. But that's where we came from in 1982, and look at where we went to 18,400 or whatever. Do you understand how big of a gain that was without a really meaningful, deep, well, we had one in 2008, a really severe drop. But, we could drop a long way here before we get this economy on solid footing again. You look at that chart and you see that we're at a really high level. And as Napoleon said famously, you can do anything with a bayonet but sit on it, and it's very true. So the downside still looks like where that's the action for me. I know China is starting to exert a force in terms of cancellation of purchases out of the U.S. and ship products and, well, out of the oil-producing countries. You can imagine a demand for steel, pipe steel for drilling, drill stock, all that kind of stuff. Oil field services, the Halliburtons, the Schlumbergers, the Chesapeake Energies that do the offshore drilling. Forget about it, okay? You're going to see bankruptcies like you never saw bankruptcies before in that sector. And that pain will spread. You throw a disintegrating commodity complex on top of that, except for the metals, and you have a real recipe for, well, let's just say a couple years of difficult times ahead. Okay, thanks so much for watching today, and I will see you next week on the update. And once again, I hope your new year is off to a great start. And you know, stay tuned. The old Chinese curse, may you live in interesting times, is certainly true these days. Thanks for watching, everyone, and stay tuned, and always more to come. Thanks.